Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Walter John Williams, or better known simply as John Williams. John's been with us a number of times before, but for the benefit of those who may not be familiar, and I can't imagine there's too many of you out there listening to this show that wouldn't be familiar with John Williams, but he has a very good, very strong academic background, having gone to Dartmouth, graduated from Dartmouth, and then took an MBA from Dartmouth as well, and has really been an independent economist, and I think that's so important because John is free to say what he believes, and he, his subscribers pay for his independent thought, and that has allowed him to provide what I think is a very excellent service to his subscribers, of which I have been one for the last number of years. I really do enjoy his work and highly recommend it, and I would suggest that all you who are listening out there go to shadowstats.com. That's www.shadowstats.com for more information on John's work, and also to sign up for his letter. Welcome, John. It's really good to have you with me again.
Thank you very much for having me, Jay.
It's always excellent having you on, because I know that you have some very controversial views on the world and on the economy, and particularly on inflation. You might have heard the last few remarks from my good friend Gene Epstein. And by the way, he has a very high regard for you as well, although I don't think he agrees on some of the issues. But Gene does.
I like Gene. He's a good guy.
He is a good guy, and one of the things that we discuss at the New York City Junto is diversity of opinion. I think it would be great to have you there sometime, John, if we could get Gene talked into having you come on as a guest. But I shouldn't put Gene on the spot like that, I suppose. But in any event, Gene's giving the economy a B. I told him, I said I would feel generous in giving it a C minus. How do you feel about the economy?
I'll give it an F.
And, an F for failure. Yeah.
Yes, absolutely. What you have here at the moment is an economy that in no way recovered from the official recession. If you look at the headline numbers, the economy plunged into 2009, mid-2009, starts recovering, generally keeps moving higher. Now it's expanded. It's 7% above where it was before the recession, but you're not seeing that anywhere else. It's an artifact of very poor quality reporting in the GDP. I'll contend the underlying reality is that the economy indeed plunged into 2009, but then you had a period of stagnation at a low level, and in many ways it's starting to turn down again. You can see that in your housing numbers, the consumer confidence numbers. I mean, yes, the consumer confidence numbers are up and down, and maybe they're up one month and people get all excited. But if you look at them in historical context, the sentiment, the confidence, they're at levels that historically have been deep in recessions, never at a peak of economic activity. We're seeing recession-level numbers there. And if you look at the long-term plot, it plunges, and then it's stagnant, maybe moving a little bit higher. You look at consumer income, median household income adjusted for inflation. Same pattern. As the economy starts to turn up in 2009, the headline GDP, the consumer median household income sinks and continues to sink into 2011, and it's stagnant basically, still such as most recently reported. The consumer here drives the U.S. economy. That's personal consumption, add in residential investment, 73% of the gross domestic product. The consumer is not seeing real growth, inflation-adjusted growth in income, doesn't have the confidence to go out and really take on a lot of debt. And if you look at the consumer credit outstanding, which the Fed publishes, that number is showing sharp growth, but all the growth in that number, and this is before any inflation consideration, has been in the federal ownership of student loans. Mm-hmm. These are not loans that are going into purchases of consumer goods. You have a liquidity squeeze on the consumer, which is making it impossible to have sustained positive economic growth in personal consumption. And without that, you've not only not had a recovery in the broad economy, you don't have one pending. And you look at the GDP numbers, they're nonsense. I mean, if you take them, if you accept them, we have now 3.9% growth. That's annualized in the third quarter, and 4.6% in the second quarter. For 2 quarters in a row like that, that's the strongest economy we've seen since 2003. Does this feel like the best economy we've been in 11 years? Main Street USA sure doesn't look at it that way. You saw the election results. Normally when people are suffering in the pocketbook, that's a major issue, and you get votes against the incumbent, which happened here.
Yeah.
If you look at the polling results, how's the economy doing? The response there was typical of an economic contraction, not an average economic growth, let alone a booming economy. If you look at the S&P 500, adjusted for all the gimmicks with share changes and such, and adjusted by the government CPI inflation, the sales of the S&P 500 basically have been flat over the last couple of years and have turned down in the third quarter. They were negative in the third quarter, not to the upside. What you see here, this is not a real economic boom, and it's being used as a prop, a false prop for the U.S. dollar, which is disrupting the markets heavily. Mm-hmm. One other area, and that's directly tied to inflation, which I know is an area you want to get into, but it also affects the way the economy gets reported. If you go back to the early 90s, Alan Greenspan was making noises about how the CPI overstated inflation.
Right.
And if you asked him, well, why is that the case? They'd say, well, if steak gets too expensive, people can buy more hamburger. If they buy more hamburger, then their cost of living isn't as high. Mm-hmm. And while that's accurate in a certain way, it might be a way to use inflation if you're measuring the GDP. It's not the way most people look at inflation in terms of adjusting income or as an investment target, because they want to beat the pace of inflation that they need to beat in order to maintain a constant standard of living. That's the way it's always been. That's the way the consumer price indices have been for the past couple of hundred years. By moving to a substitution-based index instead of having fixed weights and measuring a constant standard of living, they knocked about 3% off the reported CPI. This was done in the early 90s. Yeah. And with other changes in terms of what they call hedonic quality adjustments, where they adjust the quality of goods, or look at say, oh, there's an improvement, a quality improvement here that really should be adjusted into the price. They've removed any sense of the products being represented in the CPI as reflecting out of pocket expenses. Consider, for example, I mean they've got thousands of people go around and survey goods in stores, and they'll measure the candy bar, and they'll take the price of an 8-ounce candy bar. Next month, that candy bar might be in the same size package, but if it's 6 ounces, in theory, they pick that up and they adjust the price. That's a legitimate quality adjustment. There are areas like that should be done. An example at the other end is this was a decade or two back. The government put in place a new formulation standards for gasoline to improve the quality of the atmosphere. The effect was to add 10 cents per gallon to the cost of gasoline, which was a big percentage point at that time. They didn't put it into the CPI because it was deemed to be a quality improvement. Yet the fellow who was pumping the gas at the pump was moaning and groaning, I've got to pay more for my gas now to get to work. I've got to be able to cover the higher expense. He wasn't thinking, oh boy, I'm getting added value here because I've got better air coming out of my exhaust pipe. And there are a whole number, it gets very complex, and the time we have, it's not, we could spend the whole time going over that, but if anyone's just interested on my on my website, the homepage, upper right-hand corner.
Shadowstats.com.
There's a comment on inflation that details all these things that have taken place. All I've done is I've taken what the government has indicated the change did in terms of altering the annual inflation rate. And if you go back to 1980, with all the changes they've made, the idea of lowering the inflation rate of the CPI, they've knocked out over 7 percentage points of annual inflation. And that makes a big difference in the reporting. And I did hear at the end of your talk there, no, we don't have, even with my numbers, anything close to a hyperinflation yet.
Right.
We're going to go that way. But the reason... I'm sorry?
Yeah, I was going to say we want to get into that for sure, but go ahead. You finish your thought.
Okay. Well,
the reason...
talking inflation, deflation, from a deflationary standpoint, looking at it from the standpoint of the either the CPI or the money supply, and I also continue to track M3, which is what I would use from the standpoint of the money tracking money supply here, because it is the broadest measure. It includes the M1, it includes the M2, and a lot of funds that move out of M3 into M2 can make M2 look like it's growing or shrinking, where the M3 is not changing much at all. Post-2008 panic, we did have a period of official deflation. You got down a couple of percentage points year to year with the CPI, and you also saw that with M3. But I'll contend with the CPI that really was not a deflation. If they had measured it the way the historical CPI had been measured, the way prior periods of deflation had been measured, it never got below zero. The fear of deflation of an inflationary collapse like you had in the 30s, and indeed is largely tied to what happened in the 30s and the failure of the banking system. When the banking system failed then, you had a circumstance where a bank could go out of business. People lost the cash they had in the banks. There was no FDIC or anything like that. So as the banks failed, the money supply just dried up. The money supply contracted by a third. Inflation fell by about a third. And that, I know, is something that Bernanke had been scared of as this all came about. And back in his famous helicopter speech of 2002, he asserted that, the central bank today could prevent that from happening because they could always debase the dollar. And that's what he tried to do, and he actually did with some success. And he actually created some inflation. But the inflation issue here is severalfold, and as it's when you look at the forces behind inflation, we have people today, well educated presumably, who will look at inflation and say, you want to have inflation because that gives you a strong economy.
Yeah.
No. It can reflect a strong economy, but it doesn't give you a strong economy.
Yeah, right.
There are two ways you get inflation here, at least. But the positive one, to the extent there's a positive one, is when you have strong economic demand. The factories are working overtime because of strong demand. They can't keep up with the demand. Prices inflate because of a shortage of supply. That's a relatively happy circumstance because people are employed. Generally, the economy is positive. The not-so-happy circumstance is when you have a cost-push inflation from rising commodity prices, but not from the economic growth. And what Bernanke did here was to go for the negative inflation, the economically negative inflation, by debasing the dollar, forcing oil prices higher, gasoline prices higher, and we had a bout of inflation that came from that. And if you look at the dollar up and down and its strength, it's a very key factor in the price of oil and the price of gasoline. It's very strong now, and oil is very weak. And I'll contend that there's a lot more going on to the oil price than real efficient production. I think we have a targeting here of the Soviets by the United States and some economic warfare.
Yes.
But all
yes, indeed.
That sets the stage for the inflation ahead. But if you want to get into where this becomes hyperinflationary.
Yeah. Well, John, yeah. I mean, this is the issue that it seems to me that what we have now, I mean, there's some reason for concerns of deflation. And I think that's what the Fed, as you were indicating, I mean, Bernanke did not let the banks go down this time in 2008, 2009. Had they done so, we might have gotten to that deflationary environment that we had in the 30s, right?
Yes, absolutely.
But they didn't allow it to happen. So they're printing.
Not only did they not, although what they did was they stepped in. They guaranteed everything. Forget whatever the FDIC limits
right.
were. All accounts were guaranteed. They spent.
Right.
They created whatever money they had to. They bailed out whatever firms they had to. They did whatever had to be done to prevent the system from collapsing, because having the system collapse, and it was on the brink of collapse,
yes,
was not an option to them.
Okay, so here's the thing, John, that I think I want to get your view on this, but it seems to me like if you look at the average household, the middle class is being decimated, more and more difficulty. The wages, and we want to get to your inflation issues, and you talked about why you think they're much higher. By the way, what do you think the inflation rate, if you use the pre-Reagan way of accounting, what would it be right now? Would we still be 7, 8%, 9%? What?
It would be my best estimate is 9.4%.
That was your latest work and your latest...
the latest estimate, yes.
Yeah, exactly. So what we have, you can imagine, with wages not going up and costs going up, the actual cost of staying alive, I'd say, for the basic things that you need, 8, 9%, healthcare, all the other things, food, energy, whatever else you need just to stay alive, that's going up 9%. Wages, if you're lucky to have a job, they're not going up. Your wages are not increasing nominally. And so you're having a real substantial decrease in your purchasing power. Multiply that out, you say 70% or so of the U.S. economy is a consumer. Most of those consumers are being pinched. So we're not getting the demand that you would need for hyperinflation. It's not coming from the demand side of the economy, which would be a happier form of inflation, as you suggest. But as I understand in my discussions with you in the previously, what is going to trigger this hyperinflation that you believe is inevitable is a collapse of the dollar. Is that right?
That's correct. And I say the dollar in terms of its foreign exchange rate.
So that would mean the dollar vis-a-vis other foreign currencies would be trashed. Does that mean that there would be some foreign currencies that would be strong?
Yes, and probably
or relatively strong,
despite all the craziness that you're seeing in the market right now. You have, I mean, if you believe what's being published, the rest of the world's in the recession, but the United States is not.
Right. That's the propaganda.
That's nonsense. What happened in 2008, everything that was done then, did not resolve the issues. It pushed the crisis into the future, and we're still on the brink of that crisis. We're going to go through this whole thing again. Only they don't have the weapons that they had before. The economy is not recovered. The banking system may be somewhat in better shape than it was, but globally, it's you still have banking solvency issues, including in the United States. If you had normal banking circumstances in the United States, the banks would be lending normally. The economy would be much better off. At least in terms of the consumption. What Greenspan did, noting that the problem with the consumer income goes back in time, he encouraged debt expansion to make up for the shortfall in what income could provide. But with a debt collapse that came with a panic, that was no longer much of an option. And that's one thing that, again, drove the economy into the ground and has made recovery here so difficult. Where this becomes an inflationary problem is indeed with the dollar. We've seen moments, glimmers of where, that's how it's going to go. You go back to August of 2009. The Congress was stalled over the debt negotiations or the budget negotiations, and S&P downgraded the U.S. Treasury. You had a dollar selling panic that followed that immediately. There's all sorts of things done, interventions. The Swiss pegged the Swiss franc to the euro, but the rest of the world signaled what they were thinking at that point in time. Long term, the U.S. is insolvent. What would be technically things usually in insolvent countries, if they have the ability to issue debt in the currency that they also print, they don't get they still get AAA ratings because it's assumed by the rating agencies that they'll use the currency to pay off the debt. That's what's happening here. If you look at the budget deficit, if you look at the obligations of the federal government, net present value, aggregate obligations are right now about $100 trillion. That's net present values of the unfunded liabilities such as Social Security and Medicare, plus the gross federal debt. There's no way that can be covered. It's getting worse by $6 trillion a year. You couldn't even balance $6 trillion in a year with any hope of political salvation.
Okay, John, we're just about out of time here. I've got to ask you, so other currencies will be strong vis-a-vis the dollar. It's hard for me to imagine which, at least in the what I call the Anglo-American Empire. I can see perhaps in in China, Russia, where there's maybe going towards some sort of a gold-backed system. But so what should people be doing now? What should we be planning on doing?
Very simply, they should be buying gold and silver. Those are the ultimate hedges here, physical gold and silver, historical storage of wealth. You need to, what's ahead, and as you get the dollar panic, you're going to see the beginning of a sharp rise in the cost-push inflation that with the rest of the world dumping the dollar. There's $16 trillion out there that can be dumped. You're going to see a sharp spike in inflation. You want to be able to ride through this financial storm with your assets intact. Holding gold will enable you to preserve the purchasing power. It'll maintain your liquidity so that you come out the other end able to function and hopefully survive in reasonably good shape.
Okay, John, we're out of time. I want to tell my listeners it's shadowstats.com, shadowstats.com. Go there. John has a lot of very interesting and important information that's free of charge, but I would suggest you consider taking out a subscription to his letter. It's an excellent letter. I've done it for many years. If you want to know, get another view on what's really going on in the economy as opposed to what the propagandists are telling you, go to shadowstats.com. Thank you very much, John, for being with us once again. I hope we can do it again sometime in the near future.
We certainly shall. Thank you again.